Good morning, all you magnificent melonheads of the world. Happy Thursday, everybody. Today's January 23rd, 2025. The top story this morning is this obscure report we got from the Philadelphia Federal Reserve about the health of the American consumer. And as you may have guessed, it is not good, as headlines about Project Stargate and $500 billion and congratulations, you're the tech bro spouting off the biggest random number today. Here's your cookie. People can't afford their credit cards. That is what's going on here. Guys, this is a very ugly sign for the health of the American consumer, who I have to admit has shown remarkable resilience thus far, considering what the idiots in charge of fiscal and monetary policy have done to us over the last couple of years. So let's get into the number. 10.75% of all people are making only minimum payments on their credit cards. More than 1 in 10 are making only that minimum payment. And guys, if you're watching this channel, I am assuming that by now you know that making only the minimum payment on a credit card debt is a one-way ticket to indentured servitude. You will never get out from under that debt if you make only the minimum payments. As a matter of fact, credit card companies are required by law to warn you of that when you click only make minimum payment. There's a little text flashes up on the screen that says, what are you, stupid? If this is all that you do, you're never going to get out from under this crushing burden of debt. And of course, no, people are not stupid who are doing that. People have no other choice because they can't afford it, because people are being squeezed by the 1-2 punch of the increase in prices that we've seen over the last few years, combined with now higher interest rates. And well, if you can't afford life and you can't afford to borrow in order to pay for that life, the credit card pile starts to get bigger and people just can't afford to make it. 10.75% of all borrowers, that is the highest number on record, making only the minimum payments. Now, there's an important caveat there. That data only goes back to 2012. That's as long as they've been tracking it. I'm sure if we go back a few more years to 2008, 2009 timeframe, we're going to see that that number was considerably higher than it is right now. But, you know, case in point here, guys, it's the highest number on record, even though that record doesn't go back forever. It is a worrying trend. And it's also worrying because that number is rising, and it's rising faster. Now, delinquencies on credit cards, they rose. This data goes back to, by the way, this data is from the end of the third quarter of 2024. Delinquencies rose from 3.21% to 3.52%. That may not seem like a big deal to you, but that is a 10% jump in delinquencies. What do we got there? 40 or 31 basis point increase in 1 quarter. Now, let's contrast that data we do have going all the way back to the GFC. At the height of the great financial crisis, credit card delinquency rates reached 6.8%. So as far as delinquencies go, we're still a far cry from as bad as we were during the GFC, when unemployment spiked above 10%. But the fact is, if you see that minimum payment rising, and if you think about this logically, right, the sequence of events of financial difficulties, first you make the minimum payment, right? You would see a spike in people only making minimum payments first. Then you would see the delinquencies come after that, because if you can't make the minimum payment, then you go delinquent. So it's a pretty safe bet here that this rise of people making only minimum payments will be followed by continued rises in delinquencies. So not very good here, guys. Not a good sign. The pile of debt is getting bigger. The carrying cost on that debt is getting higher, even though the Fed is lowering rates. It doesn't matter because the long end of the yield curve is still rising. So the consumer is in big trouble, and the United States is predominantly a consumer-driven economy. Now, meanwhile, you know, we spent the last few years totally ignoring what was going on with the health of the American consumer, and we had this shiny new thing called the AI bubble that we all had to deal with, and we had Project Stargate. Yesterday, everybody was talking about Project Stargate, $500 billion. Oh, my God, it's so amazing. And look, there's Larry Ellison with his many facelifts is standing next to Masa-san, who is like, it's like the picture of the world's shortest man standing next to the world's tallest man. We got a little bit more nuance yesterday about Project Stargate, in particular involving Microsoft. Andrew Ross Sorkin from CNBC, I can't stand him. He's this little Pinocchio-looking MFer. But Andrew Ross Sorkin was interviewing CEO Satya Nadella about Project Stargate, and CEO Nadella, that's Microsoft CEO. He says, "Yeah, don't worry, we're in for $80 billion." Well, that $80 billion, that's the CapEx that Microsoft already announced back in January 3rd. And guys, I mentioned this yesterday when I was talking about Stargate and Oracle's data centers, and they mentioned 10 of those data centers were already under construction. All Project Stargate is they're taking pre-existing capital expenditures, right? The $100 billion that SoftBank was supposedly going to invest, Microsoft's $80 billion in CapEx that they had already announced, the data centers from Oracle that they had already announced. They're taking all of these pre-existing projects, they're putting it in a box, and they're calling it Stargate. That's all it is. And yet yesterday, people bid up AI stocks, double-digit percentages for CapEx stories that they already bought. So it was really from a sales perspective, from a stock sales perspective, because that's all Project Stargate is it's a story designed to get you to buy stocks. It was wildly successful because it convinced people to pay a second time for something they already bought. Now, we got even more interesting things because I went digging into Microsoft yesterday on this Project Stargate story, and I found a blog post on Microsoft's blog where the day before Stargate was announced, they basically are saying we are evolving our relationship with OpenAI. And typically, anytime Microsoft talks about their relationship with OpenAI, they talk about expanding on, giant leap forward. No, they're evolving. So right away, the shift in language kind of had the hair on my neck standing up a little bit. Paragraph after paragraph of restating their existing agreement with OpenAI. And then in the final paragraph, you get the meat and potatoes. They're basically telling OpenAI, if you guys want any more computing power, Microsoft retains the right of first refusal to offer that to you, but you're free to go find it somewhere else. This is Microsoft reiterating that they are done buying up chips like crazy. We already saw that earlier this year when Nadella did that blog, that podcast, and he said, I'm no longer chip constrained. Now I'm power constrained. It looks like Microsoft is, I don't want to say getting out of the GPU business, but they're not going to be gobbling them up like a kid playing Hungry Hungry Hippos in 1985 anymore. Now Microsoft is saying we need power. We don't need more GPUs. Pay attention, guys. Those NVIDIA earnings are coming up. And now they're saying to OpenAI, if you guys need more compute, go get it from somewhere else. We're not buying. They're not piling into this Project Stargate. And then a very interesting development this morning, Microsoft's head of business development and venture capital, one of the highest paid executives at the company, is resigning effective immediately with no replacement named. Now, guys, when somebody resigns effective immediately with no replacement named, that usually means one of a few things. Either the guy's like dying, he's got some major health issue. I wish him well if that's the case. Or the guy's getting fired and he's doing that to avoid getting fired. Or maybe there's some big disagreement going on in Microsoft involving the head of business development. And well, in lieu of, or in the context of all these developments with OpenAI, I wonder, are things maybe not so good in the C-suite at Microsoft involving this AI bubble right now? Pay attention to Microsoft over the next couple of months, guys. Something big is coming out of that company. And I suspect they're only the first. If Microsoft decides we're going to stop building data centers like crazy, then you better believe that Amazon, Google, and Meta will follow shortly after that. Meanwhile, we've got China is guiding their mutual funds and their insurance companies to buy more on-share stocks. And if you guys are familiar with the way the Chinese Communist Party does business, when they guide you somewhere, they are guiding you at the barrel of a gun. And so they are basically ordering their mutual funds and insurance companies to buy stocks. So what stage of the bubble is it when the government orders you to buy stocks? Is that, somebody want to help me out here? Is that a good thing when they have to do that? Or does that reflect the strength and resilience of the economy and yay, the people's stock market or whatever they call it over there? Or maybe it's the act of a desperate government that is desperately trying to prop up a flailing economy that is collapsing because of one of the biggest investment bubbles in all time, the Chinese overbuilding, the Chinese building cities that don't need to be built. Anyways, they're ordering mutual funds to put 10% of everything they have into onshore stocks, Chinese stocks, and they're ordering insurance companies to put 30% of new premiums into onshore stocks. So who wants to do a what stage there? Meanwhile, we got GE Aerospace actually posted a fantastic quarter. That's the company that makes jet engines. That's one half of the company that was GE before. Remember, they spun off Verona. You'd think GE would have had a pretty rough quarter considering everything that happened with Boeing in 2024, but that is not the case. Phenomenal numbers by GE Aerospace. New orders up 32% year over year. Sales of 9.9 billion versus 9.5 expected. Operating profit 1.9 billion versus 1.7 expected. Fantastic quarter from GE Aerospace. Now contrast that with American Airlines, whose stock was down big, as low as 10% lower this morning at one point. They're just posted their outlook. It fell way short. They're forecasting an adjusted loss of 20 to 40 cents a share versus expectations for an adjusted loss of 4 cents a share. American Airlines made a big gamble with their sales strategy. They decided to try to force people to buy direct from the American Airlines website. They tried to push out the third-party companies like Orbitz and Expedia or whatever that other one is. There's several of them. You know, all those annoying commercials about comparing flights. Anyways, that just blew up in their face. So while their United Airlines and Delta, all their competitors are reporting fantastic earnings, American is getting bludgeoned for that mistake. And last but not least, we got initial and continuing jobless claims this morning. We had a slight rise in initial claims, up 6,000 to 223,000. And we had a big jump in continuing claims, 1,899,000. That's up 46,000 from a week ago. So not such good data in the job market this morning. Why don't we shrink my big melon of a head and let's see what's going on in the indexes here. And guys, don't forget that like button and that subscribe button if you're new here for the YouTube algorithm. We do this every morning, so come on back and have your coffee with the melon heads. We do this one every day. The S&P 500 is pretty much flat here. It's down 9 points, 0.15% lower, essentially unchanged for the day. The Dow, meanwhile, is up 24 points, 0.06% higher. Again, pretty much flat for the Dow and the S&P. And the NASDAQ is down a half a point or 0.5% here, 114 points lower. So we got stocks. We'll say they're down on general, albeit not all that much. We don't need that window here. Looking at the DXY, we've got 108.2. That's down about 6 basis points, but above 108 here. So the dollar is taking a breather from the surge it's had since the start of the year. By the way, speaking of the dollar, guys, and speaking of interest rates, watch closely what comes out of Japan over the next 24 hours. The Bank of Japan is getting together. It'll happen while we're sleeping, overnight, because of the time difference here. But the BOJ is expected to hike by 25 basis points. So look for a pretty strong reaction from the market tomorrow. I don't know. It's largely expected at this point. And pretty much everybody is saying the BOJ is going to hike. So maybe it's already been priced in. But watch the Dixie and watch interest rates. Watch that yen carry trade. Will we be using the Godzilla thumbnail for the morning update tomorrow? I don't know. We'll have to wait and see. Also going on this morning, the interest rates are higher generally. We got a little bit of red in here. The 30-year Treasury, 4.860. That's up 4.5 basis points. The 10-year, 4.643, up 4.5 points. The 2-year, meanwhile, is down a fraction of a point at 4.295. And the 1 month is unchanged at 4.317. Looking over at the commodities boards, we got metals are in the red here. Gold, spot gold, down $13, $2,742. Although gold still remains within striking distance of an all-time high, it is down 0.5% this morning, though. Spot silver is at $30.27. That's off by 55 cents this morning, 1.8% lower. My favorite of the shinies is not having a good morning here. Copper is 0.25% lower. Platinum about the same. Palladium 1.2% higher. And WTI crude is pretty much unchanged here for March futures at $75.42. And speaking of WTI crude, interesting one yesterday in Bloomberg. India widens approval for Russian insurers after oil sanctions. We had talked about this one last week, that we were watching global oil prices rise because India and China were unable to get their hands on that cheap Russian crude they've been buying because of the latest batch of sanctions targeting insurance companies that were insuring Russia's shadow fleet, and that was being largely successful, forcing India and China to go onto the open market and bid up Brent and WTI futures. Well, now India is trying to get around that. India widens approvals for Russian insurers after oil sanctions. India widened backing for Russian insurers as the largest buyer of Moscow's seaborne crude strives to keep discounted barrels flowing after the U.S. imposed fresh sanctions earlier this month. As well as extending approvals for some sanctioned providers, India's Directorate General of Shipping authorized Soglace, did I say that right? Soglace Insurance Company to provide insurance for vessels entering Indian ports until February of 2026, according to the regulator's website. As Soglace isn't blacklisted by any Western nation, the new permit provides a safe option for tanker operators that haul Russian barrels to the South Asian nation and may be weary of taking out coverage with sanctioned insurers or providers unknown in the market. So India is trying to get around those sanctions, trying to keep that cheap Russian crude flowing. A little bit of geopolitical maneuvering going on there, possibly contributing to some lower oil prices. Looking over at Bitcoin this morning, $102,078 as priced on Coinbase. That's down about $1,500 from where we were yesterday. Bitcoin now down 2 days in a row, still above 100,000, but well off that 109,000 high that we saw on Inauguration Day. Crypto bulls remain eagerly awaiting something, anything from the Donald. I think a lot of the Bitcoin maxis, the crypto bulls out there, were really expecting something on day one involving crypto to propel us to new highs. Doesn't mean it's not going to happen. It just hasn't happened yet. Also, guys, keep an eye on the chart here. It looks a little possibly double toppy there. Not a good technical indicator. Bitcoin really needs a catalyst to maintain movement at this point. Now, let's talk about this credit card data. This is pretty alarming trend here in CNBC this morning. A record number of consumers are making minimum credit card payments as delinquencies also rise. Credit card consumer stress has intensified with an escalating share of credit card holders making only minimum payments on their bills, according to the Philadelphia Federal Reserve report. In fact, the share of active holders just making baseline payments on their cards jumped to a 12-year high. Data through the third quarter of 2024 shows. That level rose to 10.75% from the period, part of a continuing trend that began in 2021 and has escalated as average interest rates have soared and delinquencies have also accelerated. The increase also marks a series high for a data set that began in 2012. It has never been higher as long as we've been looking, I should say. Along with the trend in minimum payments came a move higher in delinquency rates. The share of card holders more than 30 days past due rose to 3.52%, an increase from 3.21% for a gain of more than 10%. It also is more than double the delinquency level of the pandemic era low of 1.57 hit in the second quarter of 2021. So this is important here, guys. Again, the GFC high was 6.8%. Now, where we are right now with delinquencies, we are double where we were in 2021, but only half of where we were in 2009. So depending on your context here and what you're comparing it to, this could be catastrophic or this could be, oh, well, it's not that bad. Now, I think the GFC, the worst of the GFC, maybe we want to set a higher bar than that as far as what counts as good. But the fact is the trend here, guys, it's rising and it's accelerating as it rises. The news counters a general narrative of a healthy consumer who has kept on spending despite inflation hitting a more than 40-year high in mid-2022 and holding above the Fed's 2% target for nearly 4 years. Now, take a look at this one here. The share of active accounts making the minimum payment. This is the chart from that Philadelphia Fed report here. Now, you can see this trend. It was generally increasing before the pandemic, and now we're pretty much right back on that trend we were at, continuing to rise, the highest since the data began here, and continuing upward. So, and guys, also keep in mind, as that minimum payment is rising, take a look at this chart. Consumer loans, credit cards, and other revolving plans. This is America's total credit card bill. This number only seems to ever get bigger. So more people are making minimum payments on a bigger and bigger pile of debt. It's currently $1.089 trillion. And the interest rate, the carrying cost on that debt is also rising. If you're making those minimum payments, guys, you got to move heaven and earth to get out from under that, because minimum payments, you're never going to get out of that debt. It's going to be with you forever. Now, let's talk about what's going on at Microsoft. All right, we went over everything that happened with Project Stargate, or whatever they want to call it, this stupid sci-fi name for their AI program that already existed. This is the blog post I was talking about, dated January 21st on Microsoft's blog. Microsoft and OpenAI evolve their partnership to drive the next phase of AI. Interesting word, evolve. They did not say expand. All right, if they could have said expand, they would have, but they're not expanding. They're actually, I don't want to say they're shrinking it, but this is like Microsoft and OpenAI saying, I think it would be better if we see other companies. That's never a good thing when your partner says something like that. Maybe I'm sure they're still going to be friends. Now, look, this blog post, there's 5 or 6 paragraphs and all these bullet points of reiterated nonsense of Microsoft just basically restating all of the existing terms of their relationship about exclusive access to the large language models and Microsoft Azure doing all the things that it does for OpenAI. None of this is new developments. This is all stuff that was already there. The actual change doesn't happen until the last paragraph. And you don't hide something to the last paragraph if it's good news. If it was great news, it would be the first freaking thing they say. They would be leading with it, but they buried it in the last few sentences. In addition to this, OpenAI recently made a new large Azure commitment that will continue to support all OpenAI products as well as training. This new agreement also includes changes to the exclusivity on new capacity, moving to a model where Microsoft has a right of first refusal. To further support OpenAI, Microsoft has approved OpenAI's ability to build additional capacity primarily for research and training models. They're selling OpenAI. If you guys want more compute, if you guys need more data centers, you're welcome to go get them elsewhere. They're gonna see other people. This is Microsoft, again, in the context of what Satya Nadella said about how they're no longer GPU constrained. Now they're power constrained. Microsoft doesn't want to build more data centers. They're going to build the ones they've already announced, but that $80 billion in CapEx, they're going to build power plants to power the ones that they're already building. I mean, Microsoft is the first of the big tech companies, the first of the hyperscalers to blink in this bubble. They're restating it here. They said it on that podcast. And, well, then you got this one this morning, and you can't ignore the timing here. Microsoft's business development chief, Chris Young, resigns. And there's Chris Young there. He doesn't look so happy in that Getty image. Microsoft's head of business development, Chris Young, who helped orchestrate the software giant's acquisition of Activision Blizzard, along with OpenAI, is resigning from his post after about 4 years on the job. The company said in a regulatory filing on Wednesday, this resignation is effective immediately, and no successor was named. Now, is this related to Project Stargate? I don't know, but this guy's out. Their head of business development quits a day after this Project Stargate is announced, and Microsoft is pretty much saying we're not a part of it. And, Microsoft saying, OpenAI, you're welcome to go build more data centers with some other company if you want to. And then this guy just up and quits. Apparently there is some disagreement, some consternation in the C-suite going on at Microsoft. Keep an eye on this story, guys. China guides mutual funds and insurers to invest more in stocks. What a very China thing. We're ordering you to buy more of our stocks. It's such a great investment that at the barrel of a gun, we are going to kindly suggest that you buy more of them. China is guiding local mutual funds and insurers to boost their stock purchases in the government's latest initiative to shore up its ailing equity market as it confronts the threat of higher tariffs. By the way, I just want to welcome all the CCP trolls who show up in my comments feed every time I talk about China. You guys are adorable, and thank you for the engagement. Mutual funds should raise their holdings of onshore equities by at least 10% annually for the next 3 years, while large state-owned insurers will need to invest 30% of their new policy premiums from 2025, said Wu Qing, chairman of the China Securities Regulatory Commission, at a press conference on Thursday. Regulators ordering companies to buy the stock market. Who had that one on their 2020s bingo? And by the way, is that a good thing when that happens? Well, let's look at it this way. There is money flowing into the market, so maybe that's bullish equities, or maybe China is just ordering mutual funds to act as exit liquidity for other people who have been doing a whole lot of selling lately. This policy is quite beneficial to Chinese equities, especially for those state-owned enterprises and stocks with high dividend yields, said Jason Chan, senior investment strategist at Bank of East Asia in Hong Kong. Still, the measures are aimed at stabilizing the equity market instead of giving a very large boost, which would need more catalyst from fiscal stimulus. And there's that call in Bloomberg for more stimulus. Now, take a look at the CSI 300 index, guys. If you think this was such good news for Chinese stocks, guess what? The CSI 300 didn't notice. It ended up closing the day up 0.18%. Basically gave back all of the gains on the initial surge that the market saw. Now, look, guys, the CSI 300, it was pretty much bleeding out for all of 2024. That is until October when all the stimulus rumors started. And, there was that huge rally. Everybody called a bottom in China. And China's been pretty much doing nothing but selling off ever since. As people have said, the stimmy measures announced were pretty much not enough. They want more. Please, sir, can I have some more? Now they're ordering companies to buy the market, and still the market only barely budges here. Guys, China is not going to be able to fix this via executive order or whatever the equivalent of that is in China. They need people, and they need a lot of people. And then those people need to grow up and start working and producing. That is not going to happen. China is facing a 30-year bear market, and that's if they change direction right now. And they're not changing direction right now. So in my opinion, China is uninvestable for decades to come here. I really think they're like pretty much Japan in the 1990s right now. They are entering their lost decades over there. And by the way, for that matter, possibly the whole world is. The U.S. and Europe could be doing the same. All right, let's get into a couple of these earnings we got today. American Airlines shares tumbled 10% as outlook falls short. Bad quarter for American Airlines here. The first quarter earnings outlook on Thursday fell short of analyst estimates, sending shares down as much as 10% at one point. The carrier forecasted an adjusted loss per share of 20 cents to 40 cents for the first 3 months of 2025. That's based on current demand trends and fuel price forecasts. That's wider than the 4 cents analysts were expecting. The earnings outlook contrasts with sunnier forecasts from rivals United and Delta earlier this month. Though American's full-year earnings forecast of between $1.70 and $2.70 is in line with analysts' estimates, American spent much of last year reversing a business travel sales strategy that backfired. Now, that sales strategy was all about forcing customers to buy from American Airlines' website instead of going through third-party brokers. And, well, when you screw over your best salespeople, it's not good for business. Who could have predicted that outcome? American Airlines stock down 7.1% here. The opening bell just rang, $17.33. That's off by $1.33 this morning. Now contrast that with GE Aerospace. Their stock is rising as earnings and guidance were solid. GE Aerospace reported better than expected fourth quarter earnings on Thursday. The 2025 outlook from the company looked solid too. Excuse me. Investors don't have much to complain about. Shares were rising after the results were released. New orders for the full year came in at about $50 billion, up 32% year over year. That outpaced sales and sales growth. Total revenue came in at $35.1 billion, up about 10%. Those are magnificent numbers from GE Aerospace, considering what happened with Boeing in 2024. Now, look, GE Aerospace was just spun off from GE proper. It's possible there's some dirtbaggery afoot here because sometimes when there's mergers or spinoffs, people kind of like delay orders to make the pre-merger or pre-spinoff numbers look worse. And then after they allow all that pent-up demand to come into the books, and so it shows a big post-merger or post-spinoff jump. It's possible that old trick is being used here, or it's also possible that GE Aerospace is just recovering from the pandemic supply shortages that limited jet engines, and now their sales are jumping. I don't know which is which here, but the market is buying it. GE stock is up 6% here, $200.55, currently up 6.5%. Good day for GE Aerospace. By the way, that is a 52-week high. Also, we got some jobless data this morning. Initial jobless claims in the U.S. rose by 6,000 from the previous week to 223,000 for the period ending January 18th, slightly ahead of market expectations for 220,000 to mark the sharpest rise in 6 weeks. So little bit of it was a jump here, but it wasn't a huge jump. You know, we're still, I would call this a little bit of a downtrend going back to July in the initial jobless claims. The pace of layoffs is not really that alarming, guys. That's the takeaway from this number here. The initial claims are not really a problem. The bigger problem, in my opinion, facing the market is that once people lose their job, they have trouble finding a new one. Now, that is shown in the continuing jobless claims. Continuing jobless claims in the United States increased to 1,899,000 for the week ending January 11th of 2025 from 1,853,000 in the previous week. That's a jump of 46,000. Now, you can see that in the chart here. We're pretty much at the upper bound of where we've been. That's a pretty big jump from a week ago. Not quite a new high, but you can see here, while the trend in the initial claims was down, the trend in continuing claims is clearly up, and it looks set to make a new high here pretty soon. So watch that job market, guys, especially in the context of that consumer and the minimum credit card payments here. If people start losing their jobs, then it's a good bet those people making minimum credit card payments will turn into delinquencies real freaking fast. And I just want to say thank you very much to Armando Reyes. Thank you, Armando, for supporting the channel. He says we could be at 15% unemployment right now, depending how you measure it, right? There's U6 unemployment, U2 or U4 unemployment. Who knows how many there are? There's a lot of different ways they fudge the numbers. I agree with that. We could be, depending on how you measure it. If you consider the manipulation that goes on, along with unreported job losses, could it reach 25% in 2025? Well, let me just say the reported, as stated, number by the government will not reach 25% in 2025. I think that's like your headline unemployment rate, the one that's currently, what is it, like 4.2% or 4.1 right now? That's not going to 25. I mean, if it did, it would be beyond catastrophic. That being said, I agree with your sentiment here that the actual rate of people who are not working is much higher than the government states because they put all these asterisks and riders onto it to make the number appear lower than it really is. There's a lot of people just left the workforce in the pandemic and they haven't come back. They're still out there not working, but they're not being counted as unemployed. Now, unreported job losses, also keep in mind, if somebody loses their job, they get laid off, but they're given, let's say, 6 months of severance. They don't show up on the unemployment rolls until that severance wears off. So there's a lot of people who have lost their jobs over the last few months who still aren't being counted as unemployed. That's nothing new. That's always been there as well. But I do agree, Armando, and thank you for supporting the channel, sir. Michael Gear, thank you, Michael. I hope I said that right. Thank you for being a Melonhead member for 11 minutes. He says DAX at an all-time high. DAX, that's not Delta Airlines. What? Maybe because of low debt of 60% of GDP. What is the DAX? Is that one of the European exchanges? I'll be honest with you. I don't know what that one is. Low debt of 60% of GDP. I don't know who that is, Michael. I probably should know that one. It sounds like a foreign stock index. Which one is that? Let me look that up real quick. The DAX index. Okay, that's the German. The DAX German index is at an all-time high. Well, all right, because debt is low at 60% of GDP. I don't know that necessarily debt to GDP plays a pretty big role in Germany. Look, Europe has the easy money problem that the United States has, and we're at an all-time high, right? We hit an all-time high in the S&P 500 yesterday because of the silly thing going on with Project Stargate, people buying the same story they already bought a few weeks ago. I wouldn't read too closely into what the stock markets are doing in these countries as an indicator or a barometer of the economy, right? Like, case in point, in Germany, you've got, who was it, Mercedes or BMW? I can't remember which one it was, but it was one of the automakers just shut down a factory in Germany. It's the first time since World War II that an auto factory in Germany has been forced to shut down because of market conditions. Germany is deindustrializing. Now, whatever is going on with the, and I put out a chart, maybe I'll do a video about this. I put out a chart on my Twitter feed yesterday. The money supply, at least in the United States, the money supply is rising, but it's having no effect on consumer inflation or on the Red Book Sales Index, which is basically same-store sales, consumer behavior. Because right now, private credit, private equity is pumping money. They're creating new loans, they're creating new debt, and they're pumping it directly into asset prices. So they're inflating asset prices right now. So really, don't read too closely into what those indexes are telling us. That's what I would say. You've got the economy and then you've got asset prices, and they are diametrically opposed right now. One of these two things is going to snap back to the other. Either the stocks are going to crash to where the economy is, or the economy is going to rise to where the stocks are. I don't know which one's going to be which. I know where I'd put my money on it, but hey, all-time highs. Congratulations for that one. And thank you, Michael, for supporting the channel. And Learcy, thank you very much. Learcy says, are you taking any Bitcoin profits this cycle? I haven't yet. I might. I might. All right. My plan has always been to hold through 2030, and I'm trying to stick to that plan. I'm trying to just nibble day in and day out. Look, we're still a few months away from crypto winter, in my opinion. If you go by the previous cycles, it typically happens 18 months, give or take a month. It typically happens 18 months after the halving. That puts us sometime around September, October of this year. There would be some big crypto fraud that blows up. Now, we've got the ETF thing happen this cycle around. That's new. There wasn't an ETF before, so you had a big surge of buying in Bitcoin right before the halving event happened in April. So I don't know, did ETFs move up some of that demand, or is that just an additional new source of demand? And maybe we're still going to make it till October, or maybe it just moved up the timetable by a few months. So as of right now, no, I'm not planning on taking any profits. That being said, Bitcoin is now my biggest holding by a pretty good margin, and that's not on purpose. It just, Bitcoin has gone up so much in the last 2 years. So, I haven't bought many stocks. I largely got out of stocks. I sat out the AI bubble. But hey, Bitcoin is rallying every bit as much as the AI companies are. So it's still been a pretty good year. Just be careful, guys. Prepare for winter. All right. Prepare for winter. Bitcoin winter will happen again. It's not a conspiracy theory. All right. You don't need this. You don't need one of these to say Bitcoin price is probably going to crash 50% at some point. It's when, not if. And my guess, September, October of this year. Thank you very much, Lircy, for supporting the channel. And thank you, everybody, for having your coffee with the melon heads again this morning. I appreciate you guys very much. Thank you for the super chats, and to all my members and magnanimous melon heads on YouTube and Patreon. Thank you guys for supporting the channel. Links down below, should you feel so inclined. Hi, Mom. Hi, Dad. Love you guys. Don't forget that like button on the way out. M&J wants that count up. Give her what she wants, guys. She works hard. Till next time, guys. Live small and dream big.